Hello students, good evening. Have you solved that question that we were discussing in the last class, the MCQ question? Yes, let me just share the screen again. Yes, all of you have solved it. I'm not going to spend time. Yes. So what is the answer for the first one? Madhav, a non-resident Indian aged 45 years, furnishes the following particulars. Short-term capital gain on sale of equity shares of PQ, an Indian company. These shares were purchased in convertible foreign exchange and sold on 31 Jan 2025. He invested whole of the sale proceeds rupees 5 lakh in the shares of RS Limited, an Indian company, on 1st February 2025. Long-term capital gain on sale of equity shares of AB, an Indian company, for 3 lakh 50. These shares were purchased in convertible foreign exchange on 1/10/20 and sold on 15/10/24 for rupees 7 lakh. Out of the sale proceeds, he further purchased the shares of Measures X, an Indian company, for 5 lakh on 31st March 2025. Dividend received from EQ and AB is 80,000. Assumes he out of a default regime, STT has been paid. Ignore the effect of foreign currency fluctuation. What is the tax liability on mother for AY 25-26? Yes. So what is your answer? Yes, students. Come on, tell me your answer. This was supposed to be the homework question. I'll not solve this some otherwise, if you're not going to give me the answer. Yes. Nobody is giving me answer. Have you solved this or not? This is supposed to be, students, the revision class wherein you are required to solve along with us the problems. If you will not solve the problems, you will not be able to gauge anything out of the revision class. This is not supposed to be a one-to-one class, students, wherein it's not supposed to be one-way communication class where, let's say, for example, I am just talking about the provisions. For that, the recorded lectures you can already find, isn't it? This is supposed to be a revision class where the purpose is that you solve the questions as much as possible. And that's how you gain out of this class. We have been told that, we solve the maximum questions with you. But if we are going to make all the calculations, you'll not be able to learn and will not be able to even complete one sum, students. So yes, please tell me quickly what is the answer. Anyone has solved this question? Yes? Even if you have not, let me know now. What do you think is the answer? Yes. No one? What is the problem that you're facing with this question, students? It's a very straightforward question. Yes. Okay. If you are not coming with any answer, you the answer. So the answer, what is the tax liability for mother for AY 25-26 is A, which is 58,240. So there will be 20% tax on the long-term capital gain, sorry, on the short-term capital gain. Long-term capital gain will get exempt because of the provision of 115F because he has reinvested the amount, and the dividend which is there, which is coming on that, you will again calculate the tax which is there at the rate of 10%. So, and plus you will add the cess amount. So that's how you get 58,240. Next is what is the tax liability of Madhav in respect of these incomes for the assessment year 25-26 if we opt out of the provisions of chapter 12A, assuming that his other income exceeds the basic exemption limit. Now, if he doesn't opt for chapter 12A, will he get the deduction under 54? The answer is no. If he sells shares and purchase another shares, there is no deduction for that. So even on long-term capital gain, there will be a tax rate of 12.5%. So that you will add, so which will give you the answer 87,490. Then what is the long-term capital gain chargeable to tax in the hands of Madhav in respect of sale of shares of measures AB under the provisions of chapter 12A? So when he sells the shares of AB, right? When he sells the shares of AB, there is a long-term capital gain which is realized. So in that particular case, the answer to that is nil because the amount gets reinvested entirely, isn't it? So this answer is the nil. What is the tax amount on dividend income in the hands of Madhav if he opts out of the provision of chapter 12A, ignores surcharge and cess? So in that particular case, the dividend which is there is the income which is the investment income, isn't it? So if it's an investment income, this is basically, if he opts out of chapter 12A, then it will be taxable as per the slab rate. Right? Any questions, any doubts so far? Yes. Clear? Okay, fine. Let's move back. Uh, IF, what we were left with. So I'll just quickly take you through the IFOS. So we have done the deemed dividend. Yeah. Now 56 to 10. This is talking about the three provision. Remember one, receipt of sum of money greater than 50,000 received without any consideration. So the entire receipt shall be taxable. Receipt of immovable property without consideration. If the stamp duty value is more than 50,000, entire SGV would be taxable. If it is received for inadequate consideration, then if the consideration is less than SGV, then you need to see whether the SGV minus the consideration is higher of 50,000 and 10% of the consideration. If yes, then it is taxable, the difference between the SGV and consideration. Now, if the date of registration is different from the date of agreement, then you have to check whether the consideration is received on or before the date of agreement by way of account paid check, bank draft, electronic mode. If the answer is yes, then you take the SGV as on the date of agreement. If the answer is no, then you take the SGV as on the date of registration. This is same as per section 50C provision, isn't it? So if you remember, we had spoken about section 50C of the Income Tax Act. What does 50C say? So 50C says this particular thing only. Let me take you again back to that. Yeah. So where did we talk about 50C? I think, yeah. So if you see 50C says the same thing where the SGV is greater than 110% of the sale consideration. If yes, then face value FVC will be SGV. Now if the SGV is different on the date of agreement and date of registration, then you need to see that whether the consideration is received on or before the date of agreement through the account paid check or the electronic mode. If yes, then you take the SGV as on the date of agreement. If no, you take the SGV as on the date of registration. Right? So it's the same thing in the income from other source. Now coming to the third part of 56 to 10, the receipt of any property which is other than immovable property. So the other property includes shares, securities, jewelry, work of art, bullion, virtual digital asset. Now, if it is received without consideration, FMV greater than 50,000, entire FMV shall be taxable. If it is inadequate consideration, where the consideration is less than the FMV, then FMV minus consideration. If it is greater than 50,000, then in that particular case, the differential amount or the inadequate amount is taxable. 56 to 10 doesn't apply in the case of receipt from relatives, on the marriage of individual, through the inheritance or will, from local authority, from the trust or institution or educational institution, charitable trust, distribution of assets on partition, amalgamation, demerger. If you see in amalgamation, demerger also, we discussed the same point. I told you that on the amalgamation or demerger, there is no 56 to 10 applicable in the hands of the recipient company, isn't it? Then we saw that distribution of capital asset by holding company to a wholly owned subsidiary and vice versa. Again, in the hands of the company, there is no 56 to 10 applicable, right? Then receipt by individual with respect to any expense on medical treatment for COVID, or receipt by the family member of deceased where the death was on account of COVID, 56 to 10 is not applicable. Last one, taxation of the amount received under the LIC. Now, if you remember, we had spoken about the taxation of the amount received under ULIP. What was the taxation of the ULIP? Yes. The taxation of, yes. What was the taxation of ULIP? Yes, students. Faster.
Where the maturity proceeds does not exceed 2.5 lakhs, and the premium amount percentage wise has to be looked into.
Correct. So, but that is taxable under what head of income? Under what head did we see that? Yes. Last lecture, which head of income did you see?
Capital gain.
Correct. So
It will be
units
treated as a
are
capital asset, and
correct. Correct.
STT will apply. And
Correct.
accordingly, provisions like 111A or
Correct. So basically, when it comes to the ULIP, so in that particular case, it is treated as a capital asset, isn't it? It is treated as a capital asset. So in that particular case, if the ULIP is treated as capital asset, the income on redemption of that will be considered as the capital gain. Yes or no? But in the case of LIC, see, ULIPs is a unit linked insurance plan, isn't it? So that's the reason why we can categorize, it's a unit based, right? We purchase the units basically under that. So in that case, you can categorize it as a capital asset. But when it comes to the LIC, when it comes to the LIC, in that particular case, the LIC which is there is not a capital asset. LIC which is there is not a capital asset. So if that be the case, therefore we are categorizing it in the IFOS.
IFOS.
Yes. So we are categorizing
Yes,
it in
understood.
the IFOS. Now, when you put it under IFOS, the treatment more or less remains the same. So what they say is the sum received under the LIP, which is other than the ULIPs, if the policy is issued prior to 1/4/2023, because this provision was introduced after 1/4/2023, the amount of the receipt under the LIC will be exempt under 1010D if my premium is less than 10% or 15% in case of disabled of sum assured. If my policy is issued after 1/4/2023, then it will be exempt under 1010D if my premium is less than 10 or 15% of sum assured and my aggregate premium does not exceed rupees 5 lakh. What was the threshold for ULIP?
It was 2.5 lakhs.
Correct. So if the sum is received under ULIP, the condition is 10 or 15% plus premium of 2.5 lakh. If it is more than that, then it will be capital asset and there will be
Dual
capital.
conditions, just like in this case, huh?
Right? So that is about the insurance. And if it is sum received under KMP, Keyman Insurance Policy, if it is received by employee, per. If it is received by businessman, 28.6. If it is others or family, 6.2. Now, if the conditions are not satisfied for the LIC, then this will be taxable under 56(2)(13), and this will be same. The sum received minus the premium paid. Are we clear? Now, what they are saying is sum received on the death of the person, irrespective of the limits on the premium, it will remain exempt. Sum received on the term insurance policy will remain exempt under 1010D, irrespective of the premium paid. So, term insurance policy is not LIC. That will remain exempt, the sum received on that, because that is a capital receipt. This is also a capital receipt, but this is specifically brought to tax. Are we clear? Any questions, any doubt
Yes.
with respect to this? Yes. Now, with respect to the 50C and with respect to this, 56 to 10, there is one question from the case scenario booklet, which I would like to solve with you. So you have to tell me the answers. Let me share the screen to you. Yes. Mr. Hari, a property dealer, sold a building in the course of his business to his friend Mr. Rajesh, who is a dealer of automobile spare parts, for rupees 100 lakhs on 1/1/2025, when the stamp duty value was 120 lakhs. Agreement was, however, entered on 1/9/2024, when the stamp duty value was 110 lakhs. Mr. Hari had received a down payment of 15 lakh by NEFT from Rajesh on the date of agreement. Hari has purchased the building for 50 lakhs on 12/7/2023. Hari's brother Ravi, a retail trader, sold a residential house to Walish, a wholesale trader, for 50 lakhs on 1/2/2025, when the stamp duty was 70. Agreement was, however, entered on 1/8/2024, when the stamp duty was 55. Mr. Ravi had received a down payment of 5 by a cross check from Walish on the date of agreement. Ravi has purchased the building for 32 lakhs on 17/8/2023. Now you have to select the MCQ questions option out of the MCQ. What is the amount of income chargeable in the hands of Ravi in the respect of transaction of sale of building to Rajesh, and under which head it is taxable? Please let me know. Yes. What is the answer? Yes, students. Which option is correct? 50 lakh, STCG or business income? Option C or option D? Yes, Debarata. Yes. Option C or option D? D? Yes. What do other things before I give the answer? A, B, C, D. Yes, students, what will be the answer? Okay. What is your full value of consideration? Is it 120? Is it 100? Is it 110? So, Debrata, your answer is correct, 50 lakh, but that is, coincidentally correct because 120 minus 70 is also 50 lakhs, but 70 is the stamp duty value of Ravi. It is not for Hari. So if you look at it, students, the stamp duty value, we will take it on the date of the agreement because the amount or the part payment has been received by way of an NEFT, which is an electronic transfer. All right. So in that particular case, we will take the stamp duty as 110 and we will compare it with the sale consideration, which is 100. Now, the stamp duty value, whether the stamp duty value, what we discussed so far is greater than 110% of my sale consideration. Is 110 greater than 110% of sale consideration? The answer is no. It is equal. It has to be greater than 110% of sale consideration. So since the actual consideration is less than or is equal to the stamp duty value 110% of the since the SGV is not greater than the 110% of the sale consideration, then in that particular case we will consider the sale consideration as the FVC. And then my cost of acquisition is 50 lakhs. So 100 minus 50 lakh will give me the short term, which is gain or business income. Now that we have to decide. Now, Mr. Hari is a property dealer. Mr. Hari is a property dealer. So in his case, instead of 50C, we have something called as section 43CA becoming applicable, which is same as 50C. But in the case of business income, it is section 43CA. In case of capital gain, it is 50C. Now, for Mr. Hari, 43CA is applicable. And since he is a property dealer, it will be business income. So the answer will be 50 lakh is taxable as his business income. Are we clear? Yes. Any question? 50 lakh will be considered as the business income because he's a property dealer and 43 CA section will be applicable. The calculation will be same as 50C only. Clear? Then next is any amount taxable in the hands of Mr. Rajesh in respect of the transaction of purchase of building from Mr. Hari? If so, what is the amount and under which head is it taxable? So, what will be the taxability for Rajesh? Yes. What is the amount taxable for Mr. Rajesh? Nobody has revised it, it seems. You need to give me the answers. Yes. Faster students. Yes. I'm not getting answer. It shouldn't take this much time. Please attempt wrong answer, but please attempt. That's more important. See, students, if you will not respond, how will we get to know whether you're understanding and you're required to, revise and come for the live class? But if you will not be able to solve the questions or you will not answer, you will not learn because this is what, is the expected out of the revision classes. Here we are not going to get into the chapter, each and every detail. Here, we are just simply there to revise with you to solve as many problems as we can. And that's the reason why we are spending so much time on question solving along with the revision. So please tell me the answer. At least, what you can do is in case you're not able to arrive at an answer, but tell me the approach. What is the approach that you are selecting over here? Is everybody there with me? What is the problem that the question is, giving you? Like, where are you getting stuck? Okay, let's discuss that so that I'll be able to help you to, come out of that problem. So, what is the area where you're feeling stuck in this question? क्या नहीं समझ आ रहा है ये क्वेश्चन में? Just tell me that. Yes, everyone. Is the question not clear? Yes, please. What is the question asking? Is it from study mat? The screen is not visible all this while. Looking at the question. Is the screen not visible? 1 second, let me reshare. So you should say, ma'am, the screen is not visible. Is it visible to everyone now? पहले नहीं आ रहा था क्या? अच्छा. So what is the question asking you? It is not from study mat, it is from the case scenario booklet. So what is the question asking you? क्या question पूछा हुआ है यहाँ? Is any amount taxable in the hands of Mr. Rajesh when he purchases the building? So अभी अभी हमने इसके बारे में डिस्कस किया. So which provision this question is targeting? Let's identify first that. Yes. Which is a provision? What did we discuss just now? Are you all of you together with me? Are we understanding? कुछ difficulty आ रहा है? Yes, please. Please come up and say. That's more important. See, I can give you the answer and you can, go home, say, okay, the revision lecture was done. But that's not what is the intention why we are conducting this lecture for you. So I'm giving you another 1 or 2 minutes to tell me what is the issue that why you're not able to solve this question. Is it not clearer? Is it some point where you're getting stuck? So I can help you with that. I'm there to help you out. Yes. No answer? Yes, please. Okay, let me give you the answer. See, I'll not be repeating the question again and again. If you're not interested to, come up and solve this question together, I'll just go through this approach where I'll just put the question. If you're happy to answer, you please answer. If you feel like you don't know the answer, I'm giving you the answers. So here the answer is no amount is taxable in the hands of Mr. Rajesh for the simple reason that again here 56.210 becomes applicable, but 56.210 says what? 56.210 says that you need to check, we just now discussed that you need to check that whether in this particular case, my amount which is there, the inadequate consideration which is there, right, is in excess of the higher of 50,000 and 10% of the 110% of the consideration, right? So in this particular case, the inadequate consideration is there. Yes, there is an inadequate consideration because he was supposed to pay 10 lakhs, right? We will take the stamp duty value as on the date of agreement. For 56 to 10 also, as I told you that if you have received even part amount before the agreement by way of the NEFT, ECS, RTGS or account paycheck, then you consider the SGB as on the date of agreement. So here I will consider the SGB 110 lakhs. So, have I received inadequate, have I paid inadequate consideration? The answer is yes. So the inadequate consideration is to the extent of 110 lakhs minus the 100 lakhs which I have paid, right? So there is a benefit of 10 lakh which is there, right? Now this 10 lakh, whether it is more than 50,000, the answer is yes. Whether it is more than 110% of the consideration, the answer is no. So in that particular case, 56 to 10 doesn't become applicable in my case. Are we clear? Then question number 3 is, what is the amount of income tax chargeable in the hands of Ravi in respect of transaction of sale of residential house to Walish and under which head it is taxable? 2 minutes time. If you are able to answer, it's the same thing as what we discussed for Hari. Debrata, 38 lakh STCG. You are saying 38 lakh STCG, that's the right answer. So here in this particular case, what we will consider is again here, what we need to look is that yes, he's a retail trader, so he holds the residential property as a capital asset. So there will be capital gain, right? Now, Hari was a property dealer. That's the reason why it was business income. Now he has sold the house for 50 lakh and the stamp duty value, whether we have to consider 55 lakh or 70 lakh, we have to consider that whether he has received the amount by way of an account paid check or the electronic system. Now he has received 5 lakh on the date of agreement. He has received the amount on the date of the agreement. So even if you have received the amount on the date of agreement, that is fine. But the amount has been received by way of a cross check. So if you receive the amount by way of cross check, then we will not consider the SGB as on the date of agreement. You should have received the amount by an account paycheck or by the electronic mode. So here we will therefore consider the SGB as on the date of registration, which is 70 lakh, right? So 70 lakh is the amount of my FVC, which I have to, sorry, SGB, which I have to compare it with 50 lakh. Now, whether the 70 lakh is greater than 110% of 50 lakh. So, in this particular case, if you look at the 70 lakh would be the full value of consideration as on that particular date, it is exceeding 110% of my sale consideration. So, my FVC will become 70 lakh minus my cost of acquisition is what? What is my cost of acquisition? 32 lakh. So 70 minus 32, 38 lakh, and this is short-term capital gain, right? Because this was purchased on 17/8/2023 and I'm selling this property on 1/2/2025, which is within 24 months. So this will be short-term capital gain. So 38 lakh is taxable as short-term capital gain. Is any amount taxable in the hands of Valish in respect of the transaction of purchase of residential property from Ravi? If so, what is the amount and under which head it is taxable? So whether it will be taxable in the hands of Walish. Other sources 20 lakh. Yes. So here you have to consider that in the hands of Walish. Whether there is an adequate consideration, the answer is yes. There is an inadequate consideration. How will you determine? You will look at the stamp duty as on the stamp duty value as on the date of the sale because amount has not been received by way of the account paid check on or before the date of agreement, right? So therefore, we can't consider the SDD as on the date of agreement. Same principle as 50C, right? Now here you need to look at stamp duty value 70 lakh and he has paid 50 lakh. So 20 lakh is the inadequate consideration. Now whether this 20 lakh exceeds 50,000? Yes. Whether it exceeds 10% of the sale consideration? Yes. So therefore the differential amount 20 lakh will be taxable under 56(2)(10) under income from other source. Right? Is tax deductible by Mr. Rajesh and Mr. Walish on making the payment to the seller? Yes. Yes, in both cases, under which section tax gets deducted? 194I. That's right. And what is the threshold under 194I? What is the threshold under 194I? 50 lakhs. Yes, Debarata, correct. So if your income exceeds 50 lakh, then in that, if the sale consideration exceeds rupees 50 lakh, then in that particular case, the 194I mandates the buyer to deduct the TDS. Are we clear? Yes or no? Is it clear, everyone? So this is very important question which are easily asked in the exam. So you have to be thorough with this so that you can quickly solve it in the examination. Now again doing one more question from the income from other sources. Let me share the screen. Yes. Mr. A, dealer in shares, received the following without consideration during the previous year 24-25 from his friend Mr. B. Cash gift of 75,000 on his anniversary, 15th April 2024. What will be the impact of this? 194I, who will deposit Devrata? The buyer only will deposit. This in this case, under 194I, it's a very simple process. The buyer need not obtain the tax deduction account number, the TAN number. There is no requirement for that. He can deposit from his PAN itself. He will deduct the TDS. He will deposit it to the income tax department by paying a challan which is called as Form 26QB. It's a return come challan which the buyer will use to deposit the tax amount to the government. Clear? And the procedure will remain the same as normal TDS, that is, he has to deposit within the 7 days from the date of deduction. Otherwise, the interest and penalties will be applicable. It's the same thing, it's just that there is no return which is there separately. Unlike other TDS provision, here there's a return come challan, which is a one single form. Clear, Debarata? What will happen to the cash gift of 75,000? Yes. Cash gift of 75,000 on anniversary 15th April 2024. What is the taxability of this? Up to 50,000 exempt? Yes, but this is 75,000. So this will be entirely taxable. So if you receive a cash gift
Be
more
taxable
than,
because it is
yes,
on account of anniversary
correct.
which should have
Correct.
received.
So if you see, this is entirely taxable since it exceeds 50,000. It is not that, only 25,000 will be taxable. No. Entire 75,000 will become taxable, and this is not received on wedding. This is received on the anniversary. Once wedding is over, you can't receive any gifts. You can receive gifts on the anniversary, but it will not be tax exempt gift. So the wedding is the only opportunity where you can receive the tax exempt gift. So if you see big actors, big cricketers, big politicians, they pass on the wealth during the wedding of their kids. That is how it happens. Right? Bullion, the fair market value of which was 60,000 on his birthday, 19 June 2024. So he has very kind friends who are giving him, cash gift of 75 bullion. It is like that. So what will be the taxability? Because taxman is not kind enough to exempt these, right? Whether taxman will exempt this bullion? Yes. What will be the taxability of this? Bullion is also fully taxable? Yes, Devrata, correct. So this is more than 50,000 received without any consideration, the fair market value of which is more than 50,000. So on birthday, also, if you receive it, this will become taxable. So entire 60 will be taxable. Plot of land at Faridabad, the stamp duty value of which is 5 lakh on the date, and he had purchased the land in April 2009. So he had purchased this from his friend Mr. C, who is a dealer in shares. The shares also. But first we'll talk about the plot of land, the stamp duty value of which is 5 lakh, and Mr. B had purchased the land in April 2009. He has received this from a friend, plot of land. As I said, his friends are very kind that they are giving him such expensive gifts. But how would the taxability of this will work? So plot of land received without any consideration, where the stamp duty value is more than 50,000. Then in that particular case, the entire stamp duty value of that plot of land will be taxable under 56 to 10. So this 5 lakh will be taxable under 56 to 10. Mr. A purchased from his friend C, who is also dealer in shares, 1,000 shares of X Limited at 400 each on 19 June 2024. The fair market value of which was 600 each on that date. Mr. A sold these shares in the course of his business on 23rd June 2024. What will happen? So this he is purchasing in the course of his business. And if you read the first line, he is a dealer in shares. So Mr. A is dealer in shares and he has purchased these shares, right? So this is a stock in trade, isn't it? And he has also
He
sold these
himself is
shares.
a dealer.
Yeah, he has sold the shares in the course of his business. So whether this is going to be the 56(2)(10) applicable, because 56(2)(10) is applicable on the property which is a capital asset. 56(2)(10) is on the property which is a capital asset. This is stock in trade. And stock in trade is excluded from the definition of capital asset. So therefore, here, even if he has received the shares at lesser than the fair market value, but since here it is not a capital asset, 56(2)(10) will not be applicable. Are we clear? Next one. Further on 1st November 2024, yes, it will be PGBP income then. See, PGBP also, unless you sell that stock, it can't be PGBP income also. There is no simultaneous provision under PGBP which can tax that. So this will not be taxable at all. Are we clear? Okay. Further, as on 1st February 24, Mr. A took the possession of the property booked by him 2 years back at 20 lakh. Stamp duty value of the property was 32 lakhs on the 1st November. And on the date of booking, it was 23 lakh. He had paid 1 lakh by an account pay check as down payment on the date of booking. On 1st March, he sold the plot of land at Faridabad for 7 lakh. So what will be the tax treatment here? Yes. So whether he has purchased the building for inadequate consideration, for that purpose, first identify what is the stamp duty. Stamp duty as on the date of purchase or as on the date of agreement or on the date of booking was 23 lakh, right? And as on 1st November, it is 32 lakh, right? When he took the possession. So he has paid 1 lakh by an account paid check. On or before the date of agreement, he has purchased by way of account, he has paid by way of account paid check. So we'll consider the stamp duty value as on the date of the agreement, right? Now, as on the date of agreement, the stamp duty value was 23. He has purchased for 20, isn't it? So therefore, in that particular situation, what will happen is the 3 lakh rupees which is there, this will be taxable under 56(2)(10). If it is higher of 50,000, yes it is. And 10% of consideration. Is it higher than 10% of consideration? The answer is yes. So this 3 lakh will be taxable under 56(2)(10). And on 1st March, he has sold the plot of land at Faridabad for 7 lakh. So the 7 lakh which is there, this 7 lakh which is there, this will be considered as my sale consideration Then what will be my cost of acquisition over here? For this plot of land at Faridabad, what is my cost of acquisition? No, Devrata. See, on 7 lakhs, he can't claim exemption because this is purchased 2 years before. This is purchased 2 years before. We don't know even the exact date. So he can't claim for the plot of land. He can't claim the exemption for this. And under 54, F, he can if at all. But we don't have the dates as when he purchase exactly. So he has booked it 2 years ago. And for the purposes of 54F, 54 will not be applicable. 54 is applicable in the case of sale of residential house property. He is selling the plot of land. He is not selling the residential house property. So we will not apply 54. 54F, if at all, can get applicable. But in that case also, what is the condition is that you should not own more than one residential house, and you should purchase the residential house within a period of 1 year after the transfer, right? Or construct any residential house within a period of 3 years after the date of the transfer. And you should have either purchased within the period of 2 years before. Are we getting? So now here he has he has sold the plot of land on 1st March 2025. Now whether it was 2 years before that, we don't have the answer over here. Yes, but what will be my cost of acquisition? Yes, yes, please fast. What is the cost here? What will be the cost for the plot of land? So see students, the cost will be the cost which has been charged under 56 to 10. The FMV which has been charged under 56 to 10. That will be the cost of the plot over here. Are we getting this particular point? So if you look at it here, what is my cost? This 7 lakh which is there, this is the selling price. Now this particular 5 lakh has been charged to 56 to 10, the stamp duty value. So this will be considered as my cost, not 20 lakh. How did you arrive at 20 lakh? This is going to be 5 lakh rupees. Are we clear? So is
5
this
lakhs will be taken into account, keeping in mind which provision?
49.4?
Okay.
Fine. Any other question? Fine. Here you will not get 54F because for 54F to applicable, it has to be 1 year before or 2 years after the date of the transfer. We don't know here, or we are very sure that this was, in fact, purchased 2 years before the residential house. It is not even 1 year before. So for 54F to become applicable, it has to be 1 year. Are we clear? Yes. Any question, any doubt? Okay. Fine. Is this question clear to everyone? Shall we solve one more question here? Okay. So the next question, again from your module itself, question number 3. Yes. An enterprise engaged in the manufacturing of steel balls discontinued its activities and decided to lease out its factory building, plant and machinery and furniture from 1/4/2024 on a consolidated lease rent of 50,000 per month. Compute the income for AY 25-26 of the following information. Interest received on deposits. What will be its taxability? Interest received on deposits, under which head this will be taxable? Other source, right? So this will be taxable under other sources. Brokerage paid on hundi loan taken. This is brokerage paid. This is not income. This is brokerage paid on hundi loan taken. So if you see, what they have said is in the next para, they have said a third point, interest paid on hundi and other loans which were given as deposits on interest to others. So he has basically taken the amount from hundi and he has paid on that hundi some brokerage and interest. And he has utilized the deposits for, or he has utilized the hundi amount for giving deposits to other, on which he has received the interest. So here, the brokerage paid, the question is, can we claim the deduction against this interest? Yes. Can you claim the deduction? Past. Yes. Please, friends, give me the answer. Yes. So we will get the deduction of the interest here and the deduction of the brokerage against this 1 lakh. So from this 1 lakh, we deduct 2,000 and 75,000 because these are the expenditure linked to generation of income.
It
50,000.
is incurred in order to earn
Yes.
that income. So
Yes.
it's
Yes.
allowable.
Yes. Debarata, it's 75 and not 50. Yes. Now, here, there is also a lease rent of 50,000 per month, which is there. What will happen to that? So, lease rent of 50,000. Under which head that will be taxable? Yes. Under which head that will be taxable? Yes. Under which head this will be taxable 50,000 per month? Always PGBP? No. See, that day we spoke about it. That if I have a lockdown or some labor strike, and pending that strike, I am leasing out my factory to recover my losses or recoup my losses, it will be PGBP because this is to reduce my commercial loss. But if my business is discontinued and then I'm leasing out my factory, plant and machinery and furniture, and I'm getting a consolidated rent for that, this will be IFOS. Now you could ask a question, ma'am, why is it not IFHP? Leasing of a building is IFHP, isn't it? But here it's a composite contract of leasing building, plant and machinery and furniture. That's the reason why I'm not allocating it to IFHP. Had there been a separate consideration for one building for plant and machinery, I would have put for building under IFHP. Here it's a composite contract, so it will come under IFOS since it is not taxable or chargeable under any other head. Clear? So therefore, you will also get the deduction for expenses incurred on repairs of building, fire insurance premium, depreciation, and legal fees paid to the advocate for drafting and registering the lease agreement, and the factory license fee paid for the year. Clear? Now there is an unabsorbed depreciation of 2,75,000. What will happen to that? What will happen to the unabsorbed depreciation? So unabsorbed depreciation is treated like a current year depreciation, right? And it can be set off against any head of income other than salaries. So we will deduct 2,75,000 from this income. Then last point, interest paid on 3 above, which is with respect to this hundi, includes an amount of 25,000 remitted to non-resident outside India on which TDS is not deducted. So will we get the deduction of 25,000? Will you get the deduction of the 25,000? No TDS, no deduction. So the provision of 40A1, which is there under PGVP. Same concept is also applicable for EFOS, where it says if you have not deducted the TDS, 100% will be disallowed if the payment was to be made to a non-resident. If the payment is to be made to a resident and you have not deducted TDS, then what is the disallowance? 30%. Here, since it's non-resident, we will disallow 100%. Is the question clear to everyone?
Yes.
Yes. Any questions now? Any doubt with respect to capital gain, income from other sources? Yes. Any doubt? Any questions? Yes or no? Are we clear with this? Anything you want to particularly ask? Yes. Fine. Are we clear up till whatever we have done so far? You completed your heads of income, isn't it? So if you have anything to discuss, anything to ask, please let me know. Otherwise, we'll start with the next topic. And what is the next topic? Clubbing of income. Right? So now we are starting with the clubbing of the income. So first we'll quickly recap about the clubbing of income. So let me take you through. So in case of the clubbing of income, we have these sections which are there. Now, what do we mean by the clubbing of income? So, clubbing of income means where, let's say, for example, this is an anti-abuse provision where a taxpayer is diverting the income of his to somebody else. So, this clubbing of income is a specific anti-avoidance regulation which is there. So that if it is my income which gets transferred to somebody else, then these provisions get kicked in and my income will get clubbed in the my hands on. So first is transfer of income where there is no transfer of asset. So basically transfer of income without the transfer of asset, section 60. Right? What does it say? If any person transfers the income from any asset without transferring the asset itself. Let's say for example, I hold the immobile property and I'm saying from tomorrow this rent will belong to you. That is not possible. I hold the asset. I am the owner of the asset. So this income, even if I make a contract with you stating that you will claim this income, clubbing will be attracted. Section 60 will say this income will be included in the hands of the transfer. Are we clear? So that's what section 60 says. Then we have the income from the revocable transfer of asset. What does it say? It says that if I make a revocable transfer, what do we understand by a revocable transfer? A transfer is deemed to be revocable if it contains any provision for the retransfer of the income or the asset. Or if I have a power to reassume the power over the income or the asset. So let's say, for example, if I transfer the asset to you, if I transfer the building to you, but in the contract, I have placed a power that tomorrow I can take back the asset. Or tomorrow you will give that asset to me back in case, let's say, for example, after 10 years. So then in that particular case, this will be considered as a revocable transfer of asset, and income from the revocable transfer of asset will be the income of the transferor only. So any income arising from the revocable transfer will be included in the income of the transfer. Are we clear? Clear? Now, there is an exception to that. What is the exception? If the transfer by the trust, if there is a trust under which I have transferred, now this is not revocable during the lifetime of beneficiary. So let's say, for example, if I have transferred my asset to a trust and this transfer is not at all revocable until the beneficiary is alive. Let's say if the beneficiary dies, then there can be a provision that, okay, this asset will, go back to the settler or go back to the one who has transferred the asset. That's a different story. But if during the lifetime of beneficiary it can't be revoked, then it will not be considered as a revocable transfer. Or any other transfer which is not revocable during the lifetime of the transfer, if I give the asset to you and it can't come back to me at least till the point you are alive, it will not be considered as revocable transfer. If after your death the asset comes back to me, that's fine. So basically the transferor should not derive any benefit from the income. Are we clear? So this is section 62. Now coming to section 64, let me, take you back to my notes. Yeah. So 60, 61 and now coming to 64. Remuneration of a spouse from a concern in which the individual has a substantial interest. So if, let's say for example, there is a concern from which I am giving the remuneration to my spouse in which I have a substantial interest. Right? Now, substantial interest means what? If the concern is a company, I have more than 20% of voting power. Right? Or in other case, I have more than 20% of profit sharing. Then in that particular case, the income will get clubbed in my hands. It is very common that, people give the remuneration to wife, to husband. But in this case, the income will get clubbed in my hands only, in the hands of the person who has the substantial interest. However, these clubbing provision will not apply if I possess a technical or professional qualification. If the spouse has the technical or professional qualification and because of which it is receiving remuneration. Let's say, for example, in a case where, let's say, I am there, my CA firm is there. Okay. Me and my, let's say, husband are partner in that CA firm. Now, my husband is not, sorry. Me and let's say there's a partnership firm, or let's say there is a company, and assume it's a partnership because a CA firm can't be company. Let's say there's a partnership firm and I am a partner in that firm, right? My husband is also CA. He's not a partner in the firm. Now, let's say, for example, the firm gives the remuneration to my husband. This remuneration, will it be clubbed in my hands? The answer is no. Because my husband possesses technical qualification, we are giving him remuneration because he has provided some consultancy to the firm. Let's say, for example, if my husband is just a graduate. In that case, will the remuneration be clubbed in my hands? The answer is yes. He doesn't possess that technical
Yes, it will be
qualification.
clubbed.
Correct? Or where say, let's say, for example, both of us are partner in the firm. And both of us have the substantial interest in that firm. We both have more than 20% entitlement to the profit. And we both are drawing the salary. Then what will happen? Let's say we are not CAs. Let's say I am CA, my husband is a graduate. What will happen in that case? The income will be includable in the hands of the spouse whose total income is higher. Right? So, let's say, for example, if I am having the higher income, his income will get clubbed in my hands if he doesn't possess the technical qualification. Are we clear? Yes or no? And this 20% needs to be checked along with the relatives. So not only you should have 20%, but if you hold 20%, let's say in a way that I hold 10%, my relative is holding 10%, then it will be counted as 20% voting power or 20% right to receive profit. Clear? Now, if let's say, for example, income from the asset is transferred. So if a asset is transferred and from that, there is an income which is getting generated to the spouse. And there is a divorce which has happened between the two. In that particular case, clubbing will not be applicable. So income from the transferred asset to the spouse under the agreement to live apart. In that particular case, the clubbing provision will not get attracted. Are we clear? So this is the exception. So clubbing will not be attracted in that particular case. Are we clear? Yes or no? So if income is arising to the spouse from the asset which is transferred, under the agreement to live apart. Under the agreement to live apart, in that particular case, the clubbing provision is not applicable. Now, in case, let's say, for example, where there is a transfer of the house property, by an individual to his spouse without the adequate consideration or not in connection with the divorce which has happened, then there is section 27 under the income from house property. There is section 27 under income from house property which says that the transferor shall be deemed to be the owner. So if I transfer the immovable property and this is for without adequate consideration, I am transferring it to my spouse, then the annual value will be deemed to be of the transferor. And in case it is other asset, then clubbing provision will get attracted. So if it is transfer of any other asset without adequate consideration, then in that particular case, section 64(1)(4) will get attracted. Are we clear? Yes. House property 27. Other asset, this is going to be 64(1)(4). Now let's say I've transferred the asset to my spouse. Right? And that is generating, let's say, rental income. Now she invests the rental income, or he invests the rental income into, let's say, fixed deposit. And that fixed deposit is now generating the interest. So will I club the rental plus interest income? Answer is no. I will only club
No,
the rental income. So any
interest
income,
income will not be clubbed.
correct. So income which is from the accretion of the transferred asset will not be clubbed. Only the income from the transferred asset will be clubbed. When it generated income, if it is further invested, and the income on that asset will not be clubbed. Are we clear? Now, what if, for example, where the assets which are transferred to my spouse, let's say I have given the immobile property to my spouse. Now, he uses the immobile property for the business. So, if the assets are invested in the business, then how do you club the income? So, the income arising to my spouse from the investment in business, the proportionate income with respect to the value of that asset, then that will be clubbed in my hands. Are we getting it? So, in that particular case, let's say, for example, I have given a gift, let's say, of money to my spouse, which he invested in the business. And he earned, let's say, a profit of rupees 5 lakh. I have given him, let's say, 7 lakh rupees. And he has generated the profit of 5 lakh. Right? So, what I will do is, in that particular case, I will first identify what was his capital. What was his capital contribution into the firm? Right? And what is my gift which is given to him? So the total capital contribution will be taken, the own capital plus my gift which is I have given. And the proportionate amount I will club in my hands. Let's say 3 lakh is the own capital of my husband. 7 lakh I have given him. So total capital is 10 lakh. Now, let's say the business income comes to 5 lakh rupees. Right? The business income is 5 lakh. So 5 lakh into 7 lakh divided by 10 lakh is what will get clubbed in my hands. Are we clear? If I have given him a loan for bona fide intention, it is very common that I can give a loan to my husband. Sudha Murthy ji had given, some amount to Narayan Murthy ji for the purpose of starting the Infosys. Will you club that? No, it's a bona fide loan. So in that particular case, this amount then will not, 64 will not get attracted. Are we clear? Whether 56 to 10 will get attracted in the hands of my husband? Yes. No, why? It is PGBP income? No. I'm talking about 56 to 10. I'm talking with respect to the cash that I have given him, more than 50,000. I have given him 7 lakh rupees as cash. So whether 56 to 10 will get attractive. Yes. Whether 56 to 10 will get attracted, cash more than 50,000. Yes. 50,000 only applicable. Yeah, 50,000, but I have given him 7 lakh cash. So whether 56 to 10 is applicable in the hands of my husband, I have given 7 lakh rupees to my husband to start this business. Whether he will attract 56 to 10 in his hands since he is receiving more than 50,000 in cash. That's the question. No, right? Because this is the gift from the relative. He has received it from the relative, and in that case, 56 to 10 is not applicable. Clear? Then transfer to any person for the benefit of spouse. So if I transfer the asset, right, to a concern or to any other person or to any association of person, right? Otherwise, then for adequate consideration, where I'm not receiving the adequate consideration for transferring the asset. Then, if this is to be utilized for my spouse, then this income from that asset will be clubbed in my hands. So not only I'm transferring the asset to my spouse, but if I'm transferring the asset to any other person, and that amount of income that asset generates will be used for the benefit of my spouse, it will still be considered as the income of mine. Are we clear? Next provision is clubbing of income arising to son's wife. Same as wife. So if asset is transferred to my daughter-in-law without consideration by either father-in-law or mother-in-law, right? Then in that particular case, this is to be clubbed in the hands of the father-in-law or mother-in-law. Or if the asset transferred is invested in a business, same like wife. So where the assets transferred are invested by the son's wife, by my daughter-in-law in the business, right? Then the business income proportionately will be clubbed in my hands. So if I have a daughter-in-law, then in that particular case, if I give it her amount for her business, then whatever business income she will earn, that proportionate income will be clubbed in my hands, same as what we do it for the spouse. Or if I transfer the asset to any concern, to any person or to the association of person, then if it is utilized for my son's wife, in that case, that amount will get clubbed in my hand. And there will be 56 to 10 applicable in the hands of the recipient if the conditions are satisfied. If there is transfer of asset more than 50,000, the FMV of that asset, then 56 to 10 applicable in the hands of that particular entity. Whether it is applicable in the hands of the daughter-in-law, answer is no. Because again, she is a relative. But if I give this amount to any particular AOP or to any other person, then in their hands, 56 to 10 will get attracted. Are we clear? Then the last one is clubbing of the minor income. So minor's income will always be clubbed in the hands of the parent, except if the income is derived from the manual work or any activity involving the skill, talent or specialized knowledge. And it will be clubbed in the hands of the parent whose total income is greater. Are we clear? And if the parents are divorced, then the income of the minor will get clubbed in the hands of the parent who is maintaining that parent. And if the minor is suffering from disability, the parent will get to claim ATU. Further, under 1032, 1500 rupees per minor child is given as the exemption. 1500 rupees per minor child is given as the exemption. Whether this exemption under 1032 will be available under 115 BAC? Yes. Whether this is available under 115 BAC? Yes, it is not available. So basically, this is not available under section 115 BAC. One second. Are we clear? So under 115 BAC, this will not be applicable. Now, your minor includes a stepchild and the adopted child also. The minor includes the step as well as the adopted child. Now, let's say, for example, if the asset transferred is house in case the asset transferred to the minor child is house property, then which section I told you is applicable? Section 27. Section 27,
Section 27.
house property. Same as in the case of spouse. But here what they say is that if the asset transferred to a minor child, not being a minor married daughter, if it is a minor married daughter, then 27(1) is not applicable. What will be applicable is 64(1), which is basically the clubbing of income. Right? So if the asset is transferred to a minor married daughter, right? If the house property is transferred by a parent to his or her minor married daughter without consideration or for inadequate consideration, then 27 is not applicable. If it is transferred to a minor unmarried daughter or to a minor son, then only 27(1) is applicable, which says that the annual value will be taxable in the hands of the transferor because transferor will be deemed owner. And if you go under 27, 1032, 1500 rupees exemption not available because now the income is getting taxed under 27 and not under 64. But if it is a case of the minor married daughter, then in that particular case, the income from the house property will be clubbed in the hands of the parent whose income is higher. Normal clubbing. And then they can claim the 1500 exemption. If it is any other asset, be it minor son, be it minor daughter, unmarried, married, whatever, 64(1)(a) is applicable. Are we clear? Yes. Last point, coming to the cross transfer. Let's say, for example, Mr. A is there and there is Mrs. A. Then we have Mr. B and we have the minor son of Mr. B. Fine. Sorry, technical glitch. Yeah. So if let's say, for example, we are looking at the cross transfer. Now, in the case of, let's say, cross transfer, if let's say Mr. A is making the gift of rupees, let's say 50,000 rupees to Mrs. A, to the wife, right? Now, in this particular case, for the purchase of a house by her, and a simultaneous gift is made by B to A's minor son. So what we are trying to say is, let's say Mr. A is there who is making the gift to, let's say, minor son of B. Let's say he gives the house property. And Mr. B, who is parent of that son, is giving the shares to Mrs. A. So I, as a husband of Mrs. A, is making the gift to another person, Mr. B. Not to Mr. B, to the son of Mr. B. And in return, Mr. B is paying to my wife through, let's say, transfer of shares. Now, these transfers are intimately connected to avoid the tax. This is a circuitous transfer. They form part of the single transaction. So, A is making the gift to the son of B, right? And in that connection, the Mr. B is therefore giving the consideration to the wife of A. So the income of the assets transferred would be assessed in the hands of the deemed transferor if they are intimately connected, that they form part of the single transaction. So the transfers have been made by A to B to the persons who are not their spouse or minor child, so as to circumvent the provision of this section. So if let's say Mr. A would have transferred to Mrs. A, there would have been clubbing. If Mr. B would have transferred to minor son, there would have been clubbing. So in order to avoid this clubbing provision, A is transferring to the son of Mr. B and Mr. B is transferring to Mrs. A. Are we getting it? So this is a one particular transaction. So if the two transactions are interconnected and are parts of the same transaction, then it is a circuitous method to avoid the tax, then the clubbing will be attracted. So the income arising to Mrs. B from the shares would be included in the or Mrs. A would be included in the hands of the A, and income arising to the son of B will be assessed in the hands of B, because A and B both are indirect transfers. Are we clear? Any questions with respect to the clubbing? Yes. Now the last point is with respect to the conversion of self-acquired property into the HUF property. So where a member of the HUF converts his property, converts his individual property into the property of HUF, right? And this is otherwise then for adequate consideration. He's not getting any consideration in return. Then the income from that property will continue to be taxed in the hands of that member. Yes. So if he transfers the property to HUF, then income will be continued to be taxed in the hands of that member itself. Clear? Now let's say for example, if this property which is converted, now the HUF gets partition, total or partial. Now the income from that converted property is received by the spouse of that particular member on partition. Now the income will be deemed to arise to the spouse from the assets transferred indirectly by that individual, right? So this will be included in my hands on. Let's say I've put the property in HUF. Now partition happens. Now this income gets accrued in the hands of my spouse, but this will be clubbed in my hands. Are we clear? Yes. Any question, any doubt? Now, if I, let's say, earn a loss on that property, or if I, let's say, earn a business loss, there is no income on that asset which I have given to my spouse to invest in the business. Now, the business is generating loss. Whether loss will also be clubbed? Yes. Income includes loss. And if I have, let's say, given my asset to the spouse to invest in the business, I have given the cash to my husband and he's investing in the business, and the business is a loss generation. There's a business loss. This business loss will also get clubbed. It's not only that the income will get clubbed, even the loss will get also clubbed.
It equally applies to losses.
Yes, it equally applies to the losses. Clear? Any doubt, any question? Shall we take a break over here of 10 minutes? Yes? And then we start solving the
Yes,
question.
fine, ma'am.
Okay, let's take a break. question from the module. I hope the screen is visible to everybody. Yes? Okay. So the first question on the clubbing of income, let's solve illustration 7 from your module. Yes. Abhi? Okay. Mr. Madan gifted a sum of 6.5 lakh to his brother's wife on 14 June 2024. On 12th July 2024, his brother gifted a sum of rupees 5.2 lakh to Mr. Madan's wife. The gifted amounts were invested as FDs in bank by Mrs. Madan and wife of Mr. Madan's brother on 1/8/2024 at 9% interest. Examine the consequences of the above in the hands of Mr. Madan and his brother. What will be the implication? Screen visible
This is a
now?
case of cross transfer,
Yeah, it's a
and the
yeah.
accreted income will not get clubbed. I mean, uh, no, no, okay. Accreted income comes into picture,
Hmm.
does it? Okay,
No,
I'm still not sure. Let me think over here.
sure. See, here it's a case of cross transfer. You are right, right? Now, Mr. Madan has gifted a sum to his brother's wife, and his brother gifted a sum to Mr. Madan's wife. So, the gifted amounts were then invested as fixed deposit in the bank by Mrs. Madan and his brother's wife. So, these are in the nature of cross transfer. The income from the assets transferred would be assessed in the hands of the deemed transferor because the transfers are intimately connected to form part of a single transaction. And each transfer, if you look at it, is a consideration for the other by being mutual or otherwise. You have to write these kind of wording. So you
But
have
ma'am,
to,
I got
yeah,
confused by reading the line. The gifted amounts were invested as fixed deposits by the SSEs in whose name it was transferred. So for a minute, I thought it might be a case of accreted income. So
got
I
it.
fell into that trap. So,
No problem. So here is, where you will make mistake. Mistake in the exam. So you have to write these proper wordings. You can't see the problem with the examination why we, do not get marks is because we don't reproduce the words that are required. What is required is required. There's no exception. आप इसको simple language में नहीं लिख सकते. You have to use the word that this is a intimately connected transaction which is forming part as a single transaction and the consideration is mutual for each of the transfer, right? So if the two transactions are interconnected and are part of the same transaction in such a way that it can be said that the circuitous method was adopted as a device to evade the tax, the clubbing will get attracted. So the interest
ma'am,
income,
the
yes,
partial mistake that I've made, there is a room for mistake like these, right? The one which I made. I mean, keeping in mind the question that is put in front of
see,
us,
if you
this
make
cross transfer.
Yeah, if you make this kind of mistake, there are high chances that you may get 0 mark because here the question is testing that whether you know the cross transfer or not. If you write, your and their language, let's say this question is for 5 marks in exam, you may get 2.5 if you do not write this kind of language which is required over here. If you do not use the word circuitous method, it is to avoid tax or evade
Yes,
tax.
I understood
Yeah.
that point, ma'am. I could identify it as cross transfer transaction. But when it comes to the accretion, if I
Yeah.
so happen to write the accretion part also, so then
They
I
will
may
deduct
lose a
marks.
part of the marks, right?
Yes. Yes. Because it is incorrect. So if it is incorrect, they will deduct the marks. Right? So the interest income on the fixed deposit would be included in the total income of Mr. Madan, which is belonging to Mrs. Madan, and the interest income of the brother's wife would be taxable in the hands of the, to the extent of the cross transfer which is there. So basically, this 5.2 lakh, he has given 6.5. I have received 5.2. So the cross transfer is to the extent of 5.2. So the interest income on the fixed deposit of 5.2 only will be included. Now, this is also very important because you can't say that entire 6.5 lakh will get included. Right? Is the full screen visible? कुछ problem है क्या screen में?
Yes, it is visible.
Okay. अजीत जी,
मैम जो कंटेंट है ना काफी छोटा आ रहा है, मैंने आपको इमेज भेजी है, एक बार देखिए, फुल स्क्रीन में भी नहीं है ना, पूरी स्क्रीन में नहीं आ रही वो।
अच्छा,
मैंने आपको
ओके,
इमेज भेजी है, एक बार चेक कर लीजिए।
हाँ जी, ओके, अभी देख लीजिए,
या मैम,
अभी बराबर है, ठीक है,
या मैम,
ओके, थैंक यू अजीत जी।
वेलकम।
सो 5.2 लाख विच इज क्रॉस ट्रांसफर, उसके ऊपर जो इंटरेस्ट है ओनली दैट विल गेट क्लब। 6.5 तो एक को ही किया, उसके सामने मुझे 6.5 नहीं आया, सो एंटायर 6.5 के ऊपर देयर विल नॉट बी टैक्सेबिलिटी और द क्लबिंग, सॉरी देयर विल नॉट बी द क्लबिंग ऑफ इनकम। नाउ अक्रीटेड कब होगा? लेट्स से जो ये इंटरेस्ट आया फिक्स डिपॉजिट का, इफ आई एम इन्वेस्टिंग दिस इंटरेस्ट इनटू लेट्स से परचेज ऑफ शेयर्स, and shares के ऊपर if I realize capital gain or dividend, if that, whether question asks whether that will also be clubbed, so then you will use the accreted income का concept. Are we clear? Yes.
Ma'am, when it comes to the 6.5, 5.2, so to the extent of 5.2, it will be clubbed and over and above amount will be.
Taxable in the hands of wife only.
Acha, okay.
Because to the extent of the cross transfer, this will get clubbed. This is what it says clearly. Are we clear?
Yes.
Right?
Thank you.
Okay. Next question is basically illustration 8. The next illustration only. Small question. Ravi has gifted his house property to wife, Mrs. Ravi, and his married daughter, Mrs. Divya. AO has served a notice of demand on Ravi for the payment of the tax for the income derived from the said house property. Because if the income is clubbed, the AO will issue the notice only to Ravi. Examine the validity of the AO's action. Yes.
This is a case of transfer of house property, wherein it is transferred to two of them, and one of whom is a married daughter.
Yes.
So, accordingly, the chart that you had shown, that will we can go as per that. I mean, married daughter hai to deemed provisions would apply. I mean, Section 27 would get attracted, and by looking at it, then transferor Mr. Ravi. So this seems to be valid. I mean, the deemed transferor, उनको ही notice of demand serve किया है for payment of tax. So this seems to be valid. The action seems to be valid.
Okay. Gift to married daughter will not be clubbed. Divya will pay her own tax. Wife income is taxable in Ravi's income. Devrata is saying something else. So let's see what is the correct answer. 27 में क्या बोला है? Individual who is transferring the house property to his spouse. or to his minor child, not being a married daughter, shall be deemed to be the owner of the house property. Now, here Ravi has transferred to the spouse. So, 27(1) will get attracted in the case of transfer of the house property to Mrs. Ravi. So, 27(1) will say Ravi would be the deemed owner in respect of the share of house property for which he has transferred to his wife without consideration. It is very important, without any consideration. But with respect to the married daughter, 27(1) is not attractive. So, Ravi is deemed to be the owner of the share of the house property of his wife, where he has transferred the house property without consideration. So, the income which Mrs. Ravi derives will be taxable in respect of the hands of Mr. Ravi.
Ma'am, may I know where did I go wrong when it came to the married daughter part? Because I'm still not convinced. Maybe, I don't know, I'm not getting it.
Yes. I'll tell you. Let me first finish the question, then we'll go back to the chart, tell you what went wrong. So, Mr. Ravi is deemed to be the owner of the share of house property of his wife. So, as per section 65, what does it say is that the notice of demand can be served for the payment of that portion of tax levied on Mr. Ravi, which is attributable to the income derived from the share of the house property which is transferred to the wife, which is transferred to Mrs. Ravi. Right? So the income derived which is there, for that purpose, the notice can be served on Mr. Ravi very clearly. Now, in respect of the married daughter, what does it say is that the income derived from the house property which is attributable to the share of the property transferred to the married daughter without any consideration would be taxable in the hands of married daughter. That would not be taxable in the hands of Ravi. There is no clubbing because it is not given that she is minor also. So Ravi will not be responsible for the payment of the tax attributable to the daughter's share. Are we getting it? Now, with respect to the wife's share, though the income is taxable in the hands of the Ravi, but whether the tax can be recovered from Ravi, for that purpose, I'll take you to the section 65. Liability of person in respect of income included in the income of another person. What does 65 say? Where by reason of the provisions contained in this chapter, which is clubbing, or in clause 27(1), which is deemed owner, the income from any asset, right, or from a membership in a firm of a person other than the assessee is included in the total income of the assessee. The person in whose name such assets stand, notwithstanding anything to the contrary in any other law, be liable on the service of notice of demand by the AO to pay that portion of tax levied on the assessee which is attributable to the income so included. What does it mean? That even if the asset is transferred to to Mrs. Ravi, and the income from that asset is clubbed in the hands of Mr. Ravi because he is deemed to be owner as per 27(1), but the AO can only recover the liability from Mrs. Ravi and not Mr. Ravi. Are we getting this? So, two situations. One, Ravi transfers the asset to wife. This transaction is without consideration. So 27(1) says Ravi will be deemed to be the owner of the house property. and income will be included in the hands of Ravi because he is deemed to be on. But the tax can be recovered only from Mrs. Ravi and not Mr. Ravi because 65 provides that. So AO cannot issue notice on Mr. Ravi for the first share of the property of his wife. When it comes to the daughter who is married, who is not minor, clubbing doesn't apply. 27 doesn't apply. Right? So in that case, the income is taxable in the hands of the daughter. So there is no question of clubbing and no recovery from Mr. Ravi. Yes, Ravi will be taxable, Debrata, and computation will be there. But recovery cannot be made from Ravi. It will be from the person in whose name the asset is there at this moment. So now coming to your question, again going back to my chart.
There has been a number of catches involved. I mean,
Yes, it is.
in this question.
Yes, it is. It is. Where is my chart gone? It's not showing. Okay. So as I said, if it is minor married daughter, 27(1) not applicable. Even if it is minor or major, 27(1) is not applicable. But in the case of the minor daughter who is married, 64(1)(a) will get applied. Here the daughter is not minor. She is married daughter. It's not written she is minor. So even 64(1)(a) will not be applicable. Are we clear now? Did you understand where you went wrong?
Yes,
Okay.
clear.
Okay. Next question, again coming back to the module. Okay. Now, next question that we will take it up is question number 1. Mrs. E, wife of F, is a partner in a firm. Her capital contribution to the firm as on 1/4/24 was 5 lakh, out of which 3 lakh was contributed out of her own sources, 2 lakh was contributed out of a gift from her husband. As further capital was needed, she further invested 2 lakhs on 1/5/24 out of the funds gifted by her husband. The firm paid interest on capital of 80,000 and share of profit of 60,000 for FY 24-25. Advise F to the applicability of section 6414 and the manner thereof in respect of the above referred transaction. Yes. Interest of 80,000 is the interest on capital. So here, see how we have to do it. As I said, 80,000 is earned on the investment which is made of rupees, the 7 lakh which she has invested, right? Or whatever the capital amount they have considered. Now, we are assuming here the interest is, the interest on the partnership capital, which is usually 12% of the per annum, right? 12% of the capital. We are not knowing how they have calculated, but this is what interest is. Now, this is on account of the own capital she has contributed and the amount that she has taken from the husband, right? So, therefore, the proportionate has to be clubbed in the hands of the husband. How do you calculate proportionate? 80,000 into what is the husband's contribution? Gift from husband is what? 2 lakh, right?
2 lakhs has been contributed by.
Correct. So 2 lakh divided by what is the capital? So the capital that you take is as on 1/4/2024, as on the first day of the previous year, not as on the last day of the previous year, right? So you will not include this additional capital which is contributed on 1/5/24. You will include on the basis of this 5 lakh. So total is 5 lakh, 3 was her own, 2 was the husband's contribution. So 80,000 into 2 divided by 5 will give you the answer which is to be clubbed in the hands of the husband, which comes to 32,000. Yes, correct. Yes, Siddharth, 32,000 is the correct answer. What about the share of profit? Will that also get clubbed in the hands of husband? Yes. Yes, Reshan. Share of profits is exempt. This will not be clubbed in the hands of the parent.
Clubbing will not apply because exemption.
It's exempt. Are we clear? Right? So very easy topic, but small errors that you can, make in exam. Next topic is set off and carry forward of losses. Again, you have been doing this topic since a long time. You know more about it because you have also done as a part of IPCC also. First is always the inter-source set off, which means under the same head of income you can set off. There are exceptions with respect to the same head of income that you cannot set off under the same head also. What are the exceptions? Loss from the speculative business. Can you set off the loss from the speculative business against the normal business income? Right? It's under the same head. It's the business only. But you cannot set off against the same head because loss from the speculative business can only be set off against the speculative income. Long-term capital loss. It is the capital loss. Can you set it off against the short-term capital gain? No. Long-term capital, if it is under the same set off against the short-term capital gain, it has to be against the long-term capital gain. Loss from a specified business under 35AD. It's a business loss, but you cannot set off against a normal business income. It has to be against a specified business income. Loss from the activity of owning and maintaining race horses, you can only set off against the same income. So even if it says inter-source adjustment, it has to be under the same head of income, same source of income first to do it. But there are exceptions with respect to these 4 categories. Then is the inter-head adjustment. What does inter-head adjustment mean? That if you are unable to set off the loss under the same source, same head, then you can set off against other head of income. Current year loss. I'm not talking about the brought forward losses. I'm talking about the current year loss. But there are exceptions. TGVP loss can't be set off against the salary loss, isn't it? Your capital losses can't be set off against any other head of income. They can be only set off against the capital gains. IFHP loss is restricted to rupees 2 lakh for set off against any other income. Right? Speculation business loss, specified business loss, Loss from owning and maintaining race horses cannot be set off against any other income. Right? So this is the restriction on the interhead adjustment. Now, even if you cannot set off interhead, you have to then carry forward the balance loss for the next assessment years. Are we getting it? Now, understand in respect of the brought forward business loss pertaining to the following transactions cannot be set off if you go for the concessional tax regime under 115 BAC, BAD, BAE, BAA, BAB, any income. These losses cannot be set off. Losses, brought forward losses pertaining to the specified business deduction under 3580. Brought forward business loss pertaining to the scientific research deduction, the excess unabsorbed scientific research deduction, which is in relation to the contribution to the Indian company, national laboratory, social associations, research associations. But if it's an unabsorbed scientific research expenditure in relation to an own expenditure for my own company which I have incurred, that you can claim. Unabsorbed depreciation relating to the additional depreciation. Unabsorbed normal depreciation, fine, you can claim under concessional tax regime. House property loss in respect of self-occupied property cannot be claimed under 115 BAC, BAD, all this. Are we getting this? Brought forward business loss on account of specified deduction, on account of the scientific research in relation to the contribution to the outside entities, additional depreciation which is unabsorbed, and in respect of 115 BAC, house property income loss from the self-occupied property. If it is rental property, you can claim the unabsorbed loss. Are we clear? Then, current year losses, as I said, first, intersource, there is no restriction. Then, interhead, right? Exceptions are there, what we discussed about. And then you will carry it forward for the future year if anything remains unabsorbed. So first coming to the IFHP loss. Section 71B. Interhead, you can set off self-occupied ka rental ke samne. Right? You can do it. If it is not available, you go interhead. It can be set off against all the other heads of income, but there's a restriction of 2 lakh rupees. In case you opt for 115 BAC as an individual HUF, AOP, BOI, and if you have a loss from self-occupied property, this cannot be set off against income from any other head. Are we clear? You can carry it forward and set off against the IFHP income in the next year, but you cannot set off against any other head of income. So loss from one house property can be set off against the income from another house property in the next year. But if you have the carried forward loss, sorry, if you have the current year loss from a self-occupied property, if, let's say, for example, let's take an example to understand this. 5 lakh interest on the self-occupied property, right? What I can do is, I can set it off against, let's say, 3 lakh rupees of income, which I have from the rental property. Permissible? 2 lakh additionally loss is there. Current year I'm talking about. Can I set it off against the other head of income if I'm going as per 115 BAC? Can I carry it forward? Yes. Next year, again I have 5 lakh rental income. Can I set off the past year 2 lakh rupees? You can. So you can
The
set
next
off.
assessment year you can.
Yes. Against only the IFHP. You cannot do under 115 BAC this set off of the self-occupied property loss against any other head of income. Are we clear? Only if you opt out. See, in the exam, be very careful. This kind of question can come. You may have to decide for the assessee which regime is beneficial. Old, new. And there you may have a house property loss from the self-occupied property. Now in the 115 BAC, you will not claim against any other head. But under the old regime, you will claim. Are we getting this? So this is with respect to the house property loss which is there. And the time limit to carry it forward is 8 years. You can carry forward for the 8 years only when you file the return of income under 139(1). Sorry, the return filing is not mandatory before 139(1) even to claim this loss. Which ITR required for set off carry forward losses? ITR 2. Debrata, ITR 2. Fine. Next is exception is amalgamating companies. Loss can be set off and carried forward by the amalgamated company, subject to the satisfaction of conditions. Same in demerger, same in succession, same in conversion of company to LLP, company LLP, this partnership firm to company, same. The inter-source set off, no restriction. Normal business loss can be set off against the speculation income, can be set off against the specified business income. Loss from specified business cannot be set off against normal. Normal loss can be set off against the specified business. Right? Then, in case excess is there, then can you set off against the other head? Yes, you can, except for salaries. And this can be carried forward for the period of 8 years, subject to filing the return of income on time. Speculation business loss can be only set off against the speculative business income. Right? Can you set off against any other head? Answer is no. What is the time limit for carry forward and set off? 4 years. But you have to file the return of income on time. Specified business loss only against the specified business income. But if the assessees are opting for the concessional tax regime, the brought forward loss cannot be set off. Right? Because specified business deduction is not allowed under concessional regime. Can you set off against other hand? No. What is the time frame to carry forward? Indefinitely, but you should file the return of income on time. Unabsorbed depreciation. No restriction in relation to the set off against the normal business income, against the specified business income, against the speculative business income, because this is deemed to be the current year depreciation. Except if it pertains to additional depreciation, then if you go for concessional regime, you are not allowed. We brought forward unabsorbed depreciation. You can also set it off against any other head of income except salary. This also can be carried forward indefinitely, and for this there is no requirement that you should have filed the return of income on time. Return
So
filing is mandatory.
unabsorbed depreciation is deemed to be taken as
Correct.
normal depreciation.
Correct. So what is the order of set off? First current year depreciation, then brought forward business losses, then unabsorbed depreciation. Because see, if you set off first UAD, then the business losses have the time limit of 8 years. So current year ka to first you will set off because this is the current year depreciation, right? Then the second priority comes of the brought forward business loss. And then UAD you can carry forward indefinitely. So then the last priority is given to UAD. Clear?
Yes.
STCL can only be set off against the can be set off against the STCG, LTCG both. Cannot be set off against any other head of income. What is the time frame to carry forward? 8 years. But you have to file return of income on time. LTCL only against LTCG. Cannot be set off against any other head of income. 8 years is the time limit. You have to file the return under 139. Losses from owning and maintaining racehorses only against such income, cannot be set off against any other head of income, and the time limit is 4 years subject to filing the return of income. Are we clear? Yes. Now coming to the amalgamation and the demerger which is there, and The change in the constitution of the firm which results in the restriction on the carry forward and set off of the losses. So now this is very, very important to understand, students. See, in the case, as I said, of the amalgamation, as I said, normally, if you carry forward the loss, you can carry forward the loss only when you have incurred the loss. Right? Only when you have incurred the loss. But in case of amalgamation or the demerger, let me take you to the module. Yep. Amalgamation, in this particular case, if there is an amalgamation of a company which is owning an industrial undertaking or which is owning a ship or a hotel with another company. So amalgamation only of these entities. An entity holding an industrial undertaking, ship or a hotel with any other company. In that particular case, or of the banking company with a specified bank or a public sector company, then in that particular case, this section which is there is applicable, which says that the amalgamation, the losses and the unabsorbed depreciation of the amalgamating company shall be deemed to be the loss or unabsorbed depreciation of the amalgamated company, and this loss can be carried forward and set off by the amalgamated company for a fresh period of 8 years. Not for the balance period which is remaining, for a fresh period of 8 years. But there are certain conditions which are prescribed. Conditions are the amalgamating company should have engaged in the business for 3 or more years. Amalgamating company should have held on the date of amalgamation at least 3/4 of the book value of fixed assets held by it for 2 years prior to the date of amalgamation. The amalgamated company should also hold 3/4 of the book value of assets for a minimum period of 5 years from amalgamation. Amalgamated company continues the business of amalgamating company for at least 5-year period. The amalgamated company shall achieve the production at least 50% of the installed capacity before the end of 4 years from the date of amalgamation and should maintain this level of production till the end of 5 years from the amalgamation. In case they do not fulfill these conditions, then the unabsorbed depreciation and the carry forward loss will lapse, and this will be treated as the income of the amalgamated company. Same case is in the demerger. The loss of the demerged company and the UAD will be carried forward and set off by the resulting company, but not for a fresh period of 8 years, year for the balance period. Because demerger में क्या होता है, कंपनी ऑलरेडी इन एग्जिस्टेंस था, अमालगमेशन में क्या था, कंपनी एंड हो गया, right? Demerger में both the companies are existing, so they allow only for the balance period of 8 years, right? Then in the case of the reorganization of business due to succession, conversion of company to LLP, conversion of LLP, partnership firm, sole proprietor to the company, all these cases, again, the successor entity will be allowed the losses and UAD of the predecessor entity for a fresh period of 8 years, provided they satisfy the conditions of the exemption under 47(3)(4)(5). We saw, right, what were the conditions? We saw what were the conditions, isn't it? For the exemption, isn't it? The conditions for the exemption were that partners should remain the same. More than 50% of the partners, shareholders should get transferred. They should get entitled to the profit sharing ratio, right? Those conditions, if not satisfied under the capital gain exemption, then in that case, these losses will be deemed to be the income of the successor entity. Are we clear? Yes? Any questions, any doubt with respect to this? Fine. Now, another important point is the section 78 and section 79. Now, what is that? Section 78, which is there, is carry forward and set off of losses in the case of change in the constitution of the firm. So, let's say, for example, if there is change in the constitution of the firm. What do we mean by change in the constitution of the firm? Change in the constitution of the firm means that if there is death, retirement, admission of the partner, then what they say is that the share of the loss of the retiring or deceased partner shall not be carried forward and set off by the firm. So let's say business loss is 1 lakh. Let's say there is a partner which is outgoing, which is retiring, which is deceased, who has died. Let's say he was 50% partner. 50,000 will not be carried forward by the firm. Change in the profit sharing ratio is not going to impact this. And here they are only talking about the business loss, not the unabsorbed depreciation. Unabsorbed depreciation will not be impacted by Section 78. So in case there is change in the constitution of the firm, the share of the retiring or deceased partner will not be allowed to be carried forward and set off by the firm. All right. Then, in case there is a succession of the firm, one firm takes over the another firm, otherwise then by inheritance, then the successor company cannot, or successor firm cannot carry forward the losses of the predecessor. Exceptions are amalgamation, demerger, conversion of company to LLP, or sole proprietary or partnership firm to the company. If it is succession by inheritance, then the losses can be set off and carried forward by the predecessor. Last section, section 79, which is the carry forward and set off of losses in the case of change in the shareholding of a closely held company, not a widely, closely held. If it is a company other than a startup, then the company can carry forward and set off the losses only when the shareholders carrying not less than 51% of the voting power remain the same in the previous year in which loss is incurred and the previous year in which the loss is set off. Are we getting it? But if it is a company which is a startup referred to in section 80 IAC, if it is a company which is a startup which is registered under, or which is a startup referred to in 80 IAC, then any brought forward business loss shall be allowed to be carried forward and set off if on the last day of the previous year, either the shares carrying not less than 51% of the voting power, right, remain the same in the year of the incurrence of the loss and in the year of the set off of the loss. This is after the 10 years of incorporation. For the first 10 years of incorporation, they have removed this condition. What they have said, even if there is change in the 51% shareholding, all the shareholders should remain the same in the year of incurrence and in the year of set-off. So let's say, for example, if A, B, C, D are the partners, or the A, B, C, D are the shareholders, for the year 2022-2023, there is a loss, which is now to be set off in the year 24-25. All of them are 25% shareholder. Let's say in 23-24, A transfers the shareholding to X. Right? Now more than 51% are same? Yes, they are same in the year of incurrence and in the year of set off. In 24-25, A, B, C both have transferred their shareholding to XYZ. Now, in the year of incurrence, there was A, B, C, D who were the more than 51% shareholder. In 24-25, the shareholding is not same. 51% of shareholders are not the same in the year of set-off. But since it is a startup and since this is a loss incurred in the first 10 years of incorporation, even if more than 51% shareholders are not same in the year of incurrence and in the year of set-off, but if all the shareholders remain the same, that is the shareholders are there who were there in the year of incurrence and in the year of set-off, there is no problem. If it is after 10 years, then 51% condition will be applicable. Are we clear? Yes or no? Any questions? Any doubt?
Yes, clear.
Clear? Fine. So let us solve the questions now. Okay? Yes. Okay. So first question is illustration 6 from your study mat. Let me share the study mat again. Okay, this is compute the total income of Mr. Furnace for the AY 25-26 for the following information given below. Income from house property they have given, income from business they have given before depreciation, short-term capital gain they have given, long-term capital loss from the sale of property brought forward from 20 to 20. So what we will do with this? Is there long-term capital loss? What do we do? Can we set off only against long-term capital gain? Is there a long-term capital gain? Yes. Is there a long-term capital gain? No. So this will be carried forward and set off against the long-term capital gain in future. Fine. Income from tea business, dividend from Indian companies carrying on the agricultural operations, current year depreciation and brought forward business loss. Loss was incurred 6 years ago. So see, first we'll start with the house property, 1,25,000. We'll include that as income. Now this is profit before depreciation, 1,35,000, right? Now income from tea business, what will happen to this? What will you do with the tea business? Yes, business income is 40%, correct. Yes, 40-60, correct. So 40% will be business income, 60% will be agricultural income. What about dividend from Indian companies carrying on agricultural operation? Yes. This will be income from other source, right? Dividend is always taxable under IFOS.
It is taxable.
Yeah, it is IFOS. Even if it is from agriculture company, none of the business. It is dividend, so taxable under
It doesn't
IFOS.
matter. It will be taxable.
Then current year depreciation, you will set off against the profit before depreciation, right? We'll set off the current year depreciation. And then we have brought forward business loss, so we'll set off that as well. So very simple question, right? Fine, this is what it is. It's nothing technical. Sometimes you think in ICAI exam how this question can be so simple, isn't it? But sometimes ICAI can ask you the simple questions also, right? Fine? Okay. Now, coming to the next question, then question number 1. X is carrying on a business as sole proprietor, died on 31st March. On his death, the same business was continued by legal heirs by forming a firm. As of 31st March, a determined business loss of 5 lakh is to be carried forward. Does the firm constituting of all legal heirs of Mr. X get a right to have this loss adjusted against the current income? We just now discussed this. Yes. Yes, they can. So if the succession is otherwise than by inheritance, if it is not amalgamation, but if it is succession by inheritance, so even if the heirs now are constituting their own partnership, the heirs, since they have succeeded the business of their father, it is succession by inheritance and the loss of the predecessor can be carried forward and set off by the successor. Clear? Fine. Next question. JKLM, a firm consists of four partners, JKLM. They share profits and losses equally. The assessed business loss, which is entitled to carry forward, amount to 360. A new deed was executed among JKLM on 1/4/24 in terms of which they agreed to share the profit and losses in the ratio of 15:15:20:50. Compute the business loss relating to 24/25, which the firm is entitled to set off against the assessment years, against the business income for the assessment year 25/26. The business income of the firm for the AY 25/26 is 3,30,000. So can the firm carry forward the losses? Yes, very simple question. Again, we just discussed it. Yes. So change in the profit sharing ratio, as I just now said, doesn't result in change in the constitution. So the firm can carry forward the losses. In case the change in constitution is due to the death or retirement of the partner, then the outgoing partner's share shall lapse. This is not the case. Change in profit sharing ratio doesn't trigger the change in constitution. So they can carry forward and set off the losses. So against the 3,30,000 income, first they will set off the 3,30,000 and balance 30,000 they can carry forward in the future year. Are we clear? Fine.
Yes.
Okay, now last topic is chapter 6A deduction. I'm not going to discuss each and every deduction one by one. We are just going to solve few questions from that particular topic. The reason is that you have, again done this particular chapter, extensively in your IPCC also. And this is very self-explanatory chapter also, right? So we will focus on solving the questions with respect to this. So the first question from the module itself, illustration 6. Yes. The basic salary of Mr. Arjun is 1 lakh. He is entitled to DA, which is 40%. 50% of DA forms part of the pay for retirement benefits. Both Arjun and his employer contribute 15% of basic salary to the pension scheme referred to in 80 CCD. Examine the tax treatment in respect of such contribution in the hands of Arjun if he has exercised the option of shifting out of the default tax by the state government or the central government to the NPS account of its employee is given as 14% of salary as deduction. It is over and above 1.5 lakh that you get under 80 CCD. Contribution by any other employer to the NPS account of the employee is 10% of salary if you go as per the old tax regime. If you pay the tax as per default tax regime, it is considered as 14% of the salary. Are we getting that? So in that particular case, this is also outside the limit of 1.5 lakh. Now, here the basic salary is 1 lakh per month. He is entitled to DA, which is 40% of basic salary, right? So in that particular case, what will be the deduction which will be available to him? First, we will consider that he has been going as per the old tax regime. So 1 lakh per month is the basic salary, which is 12 lakh. Dearness allowance is 40% of the basic salary, which comes to how much? 4,80,000, right? And 50% of the dearness allowance forms part of the retirement benefit, which comes to 50% of 4,80,000, so 2,40,000. So for the purposes of 80CCD calculation, you will take the salary and the DA which form part of the retirement benefit, right? Not the entire DA, but DA which form part of the retirement benefit. Now, the deduction under 80CCD2 will be how much? No, how 50,000? That is for 80CCD. See, if you look at 80CCD, one is the contribution to the NPS of government, which is 10% of salary or 20% of the gross total income. 80CCD 1B says contribution to the NPS notified by the central government is over and above 50,000. This is the employee contribution. We also have the employer contribution under 80CCD 1B and 80CCD 2, which is over and above 1.5 lakh. So here, how will you calculate? Yes, Siddharth. It is 10% of. See, I'll explain you how we have to go about. As I said, 12 lakh is my salary. No, we will not take 12 lakh. Why? So 12 lakh is my salary. Dearness allowance is 40% of 12 lakh, 4 lakh 80. They are saying that 50% of the dearness allowance form part of the pay for retirement benefit. So 50% of my DA is only forming part of the retirement benefit. So for the purposes of my calculation for 80CCD, I have to consider basic plus DA, which is forming part of the retirement, not the entire. So 2,40,000. So my salary for the purpose of 80CCD lakh 40. Now the deduction under first 80CCD1, he has contributed 15% of basic salary to the pension scheme. So 15% of 1 lakh rupees, he has contributed 15% of the basic salary of 1 lakh per month, which comes to 1,80,000. 15% of 12 lakh in a way. 1,80,000 he has contributed. But the restriction under 80CCD1 is that it will be only 10% of 14 lakh 40. 10% of not 12 lakh, 10% of 14 lakh 40, which comes to 1,44,000. He has contributed 1,80,000. I will only get 1,44,000. Plus, I will get additional 50,000 under 80CCD 1B. Right? Now, this 80CCD 1B, how much I will get? I have allowed 1,80,000 minus 1,44,000. So the balance is only 36,000. So the amount which is available as deduction is restricted to the amount which is contributed. ऐसा नहीं होगा कि 1,44,000 plus 50 and you have contributed in total only 180. So you will get deduction of more than what you have contributed. That is incorrect. So 1,80,000 is what my contribution is, out of which 144 I have considered under 1. So additional under 1B will not be 50, it will be restricted to 36. Are we clear? So 1,44,000 under 1, 1B may it will be 36. Now 1,44,000 is subject to the overall limit of 1,50,000. This 36 can be additional over and above 1,50,000. Right? Any question? So what you can alternatively do is, see, let's say for example, now you are also contributing to LIC. तो क्या हो जाएगा? यहाँ पे if you just claim 36, here you can claim in fact 50, additional 50, isn't it? But because I am consuming 144 over here, this gets restricted. So I will use 50 over here because the total has to remain 180. So I will put 50 over here for the 1B and 180 minus 50, I will only take For 1 lakh 30. Because then 20 I can still use, let's say, for my LIC. And here I'm additional getting 50. Otherwise, additionally here I'm only getting 36. Now, employer contribution, if you go as per old regime, will be maximum 10%. Therefore, here it will be 10% of 14 lakh 40, which is 1 lakh 44. Yes or no? So there is employer contribution will also be allowed a deduction under 80CC2 subject to the maximum of 10% of salary. Are we clear? And this is over and above 1.5 lakh. Now, if he goes as per 115 BAC, then in that particular case, what additional will happen is everything will remain same. But employer contribution will now increase to 14% of 14 lakh 40, which is 2 lakh 1000. Clear? Yes or no? Yes. So first avail under 1B and then go for 1. That is right. Is this question clear? Yes, students. Is this clear to everyone? Fine. Yes or no, at least. I'm not getting any answer. Clear to all?
Clear.
Okay. Yes? Okay. So this is very, very important, for the purpose of the calculation where the questions come on 115 BAC versus the normal provision. Okay?
Normal provision.
Yeah. Let's solve one question, another question. Illustration 40. Following are the particulars relating to Arun, Barun, Chetan, Dinesh. Okay, they have taken the loan and loan is taken from the Housing Finance Company, NBFC and Public Sector Bank. They have given the date of sanction of loan, date of disbursement of loan, purpose of the loan is for the residential property for self-occupied. They have given the stamp duty value. It is for again the residential house property for self-occupation. 48 purchase of electric vehicle for personal use, and this is also for personal use. They have also given the rate of interest. Now compute the amount of deduction which is available if they have exercised the option of opting out. Assume that there is no principal repayment. Okay. Now let's say, what does this say? Provision. So if you look at these two provisions which are there, first is the deduction in respect of interest payable on loan taken for acquisition of residential house, 80EE. It says the stamp duty value, not the sale consideration, the stamp duty value of house is less than 45 lakh. Individuals should not own any residential house on the date of sanction of loan. The individual should not be eligible to claim deduction under 80EE, and the loan should be sanctioned between 19 to 22. It should be sanctioned, not taken. Okay. The period of benefit is deduction would be available for the interest payable for each year. Deduction is 1 lakh 50, which is over and above the deduction under 24B for the interest on house property. And this loan should be taken either from a bank or a housing finance company. Right? This is available only if you opt out of 115 days. So in case of a self-occupied property, you have a restriction of deduction under 24B, plus you can claim the deduction under 80EE for 150. For let out, no restriction under 24B, but the maximum set off available against the other head of income is 2 lakh. And over and above that, you can claim under 80EE. Clear? Now, 80EE is with respect to the purchase of the electric vehicle, and the loan should be sanctioned to 23. Loan should be via financial institution, which could be bank or specified NBFC. Now, in this particular case, first for Mr. Arun, whether you will get deduction under 80EE. Yes. Can I show the SDB? Yes, I can show the SDB. So 43 lakh is the amount of loan which is taken, right? My SGB, which is less than 45 lakh, right? So I can avail the 80EE, right? So in this case, first 43 lakh into 9% is my rate of interest, right? And the loan is 43 lakh. So I will also get the deduction under 24B for the self-occupied property, which will be restricted to 2 lakh rupees, right? So this is restricted. Secondly, if you look at whether the conditions are satisfied, what were the conditions which were there? The condition was that the stamp duty value less than 45 lakh. Is my stamp duty value less than 45 lakh in this case? Yes, it is, right? It is exact 45. It should be less than equal to. I'm satisfying the condition. Second is the loan should be between 19 to 22. It is sanctioned between 19 to 22, isn't it? So if you see the date of sanction is 21. So I will also get the deduction under 80EE, which is over and above 2 lakh that I have claimed. So 387 is the total loan, out of which 2 lakh I have claimed. So 150 I will claim under this particular 80EE. 187 is there, but restriction is 150. Coming to Barun, now this is also sanctioned between 19 to 23, 19 to 22. This is exact. The property value is 48 lakhs. So he will not be eligible for this particular section. Are we clear? Yes, if the age is 65 or more, then what will be deduction? It will be same, na? It is not talking about the restriction in respect of the age, isn't it? It just says individual who has taken the loan. So there is no restriction of age. Now, Barun will not get, he will only get the deduction under 24B, which will be 45 lakh into the rate of interest is 9%. So up till 2 lakh, he will get. Fine. Now, Mr. Chetan, he has taken the loan for the purchase of the electric vehicle, right? So electric vehicle, the date of sanction which is there should be between 19 to 23. Isn't it? For Chetan. Now he will get the deduction under 80EE, which will also be restricted to 1.5 lakh. So what is the loan amount which is there is 20 lakh into 10%, but the restriction will be 1/4. This Mr. Dinesh has purchased the electric vehicle, but here the date of sanction of loan is 2019 30 March. So it was sanctioned before 1/4/19. So there is no deduction available for Dinesh. Clear? Yes or no? Is this clear? Fine. Everybody. Again, a very simple question, which but require that you remember the limits over here. If you forget the limit, you will not be able to solve. Right? Another question. Let us solve one more question. Illustration 18. Let us solve illustration 18. Let me just open up that illustration for you. Yes. Mr. Vikas has commenced the business of manufacture of computer on 1/4/24. He employed 420 new employees, the details of whom are given here under. The regular employees participate in RPF while the casual do not. Compute the deduction, if any, available to Vikas if the PGBP derived from the manufacture of computer is 90 lakh and total turnover is 11.48 crore. Assume, what would be your answer if you assume Mr. Vikas has commenced the business of manufacture of leather on 1/4/24? This is the deduction under 80JJAA. Now, what does this deduction provide? This is for the new employees. So, where the assessee to whom the tax audit is applicable has the profit and gains from business, the 30% of the additional employee cost would be allowed for the period of 3 assessment years from the previous year in which employment is provided. The conditions are business should not be formed by splitting up. The business is not acquired by way of transfer from other person. And here what is the additional employee cost means? In the case of the existing business, the employee cost will be basis the additional number of employees which are hired, right? As per the employees which are hired on the last day of the preceding year. And the salary of these employees are paid through the account pay check or electronic mode, not in cash. In the case of new business, it is the new employees which are hired. Now, who is included in the employee? Employee does not include the employee whose salaries are more than 25,000 per month, the employee for whom the contribution is paid by the government under the EPF scheme, the employees which are employed for a period less than 240 days. In the case of leather business, footwear, apparel, the 150 days is considered. And the employee who does not participate in the RPF. Right? Now, if the employee is hired for less than 240 or 150 days during the current year, but he is present in the next year for more than 240 or 150 days, then it will be deemed that he has been employed in the next year. Are we clear? Now, what will the salary be? Salary will include all the salary, but will exclude the employer contribution to PF or leave encashment or the termination benefit.
Recording in
Less
progress.
than 240 days. Now, if he was in the business of the manufacturing of the leather, then in that case, they business you take 150 leather, footwear, apparel. But if these employees, even if I consider 240, if they have not been present for 240 in the current year, but if they have been present for 240 in the next year, then in the next previous year, I will get the deduction of 80 double J double. Are we clear? Yes. 24,000 per month into 12 months into 75 employee, 30% of this I will get the deduction for the period of 3 years. Clear? Yes or no? And this deduction is available under the old as well as the new regime. Mind that. This is available under the old and the new regime both. So be very, very, very clear about this fact. It is not that you will not get this deduction under the new regime. You will also get in the examination. An overall question can be asked on this particular point, where this could be just one of the adjustment. Clear? Last question before we close. X Limited has two units, Unit N and Unit Y. N is engaged in the business of generation of power, installed a windmill March 25 and had a profit of 100 lakhs in AY 25-26. X has claimed the depreciation of 120 on windmill against the 100 of the profit from the power generation business, which was eligible for deduction under ICAI. Unit Y engaged in the manufacture of wires, non-eligible business, had a profit of 70 lakh for AY 25. The loss of 20 lakh, that is balance depreciation not set off pertaining to Unit N, was set off against the profits of the Unit Y carrying on the non-eligible business by the assessee X Limited. The AO was of the view that the depreciation relating to the business eligible for reduction under ICAI cannot be set off against the non-eligible business income. Hence, unabsorbed depreciation should be tells you as there can be loss of the unit which is eligible for the deduction under ICAI be set off against the income of the other business, which is a normal business. That is what the question asks you. Now, this is a very classic case of tax avoidance, and that is the reason why they ask you this particular question. So, I will show you what it means here. See, let's say X Limited is there, depreciation is 120, so there is an unabsorbed depreciation of 20 or loss of 20. Profit of the non-eligible business is 70. Now, this has been the case because here ICAI was applicable. Here there is no ATIA. So can I set off as per section 70 as the intercompany loss or inter-source loss? So it has been said that the losses of the eligible business can be set off against the non-eligible business income under section 70. Since there is no profit from the eligible business, ATIA is not applicable and therefore section 70 will allow us to carry forward the losses. Because there is no ATIA applicable since there is no profit, so section 70 which says that the loss from one source can be set off against the another source. Right? So this is allowed to be set off. Is it clear? Yes or no? Yes or no? Is this clear? So this has to be set off. Now, in the next year, when you will claim the deduction under ATIA, when you claim the deduction under ATIA, let's say for example, if there is loss from a non-eligible business. So see, X is entitled to benefit of set-off of loss of 20 lakh pertaining to this unit against the against the unit Y. Now, once this set-off of loss is allowed, then in the next year, how will I calculate the deduction under ATIA? In the next year, what they give benefit is, let's say in the next year, my profit is 90 lakh. Let's say my profit is 90 lakh. Now, this 20 lakh, which I had set off against the non-eligible business income, this I will consider that this eligible business is my only business. When you calculate the ATIA, they say that you consider that this is your only business. So I will set off the loss of the last year against the profits of my eligible business before giving a deduction under ATIA. Are we getting it? So next year, when this, let's say the income is there of the unit N, this has to be reduced for 20 lakhs for computing the profits eligible for deduction under ATI. Are we getting this particular point? So, I will get the set off of the losses.
So if you in the next year, only 90 lakhs will be considered.
90 minus 20. Let's say, for example, if you see this example, 120 was my loss. I set off against non-eligible business, my GTI became 0. Next year, I have 20 as the eligible business. Now, I should claim ATI. I will not be entitled to claim ATI because this 20K against, I will first set off 20. Next year, again, I have 60. I will again set off balance 100. So, 60 will get set off. Then only 40 remains. In 23-24, again 75, I will set off 40. And after that, I will give deduction under ATI. So even though this is set off as per 70, but for the purpose of calculating ATI, I will consider this was my only business. And therefore, the losses of the earlier year will reduce my ATI.
Recording in progress.
You will be eligible to claim a lower ATI because it should not happen that, you say that, okay, in 1 year I have lost, I have set off against normal income. In the next year, I will claim higher ATI. So in the first year also, you are getting benefit by setting off the normal business income. In the next year also, you are claiming the benefit by claiming higher ATI. So that should not happen.
So in the immediately succeeding year, you can't avail the benefit, I mean.
Only to the extent of the balance losses that you claimed in the last year.
Okay.
Fine. Okay. So that's all for today. Thank you so much. We'll meet in the next class.
Thank you so much, ma'am. Ma'am, I would want to reiterate about the notes. The thing is, until today, sometime back, it was not available. I'm not sure about now. but the status is like the
I'll
last
talk to them.
session plus this session as well.
Sure. Sure. Okay, I'll talk to them.
Please, ma'am, please do the
Sure.
needful.
Okay.
Yes.
Okay.
मैम
Thank you. Yes.
Thank you so much.
मैम जो नोट्स आपने प्रोवाइड किए थे वो ऑलरेडी अपलोडेड
है ना? ठीक
हाँ
है,
जी
चलेगा। ठीक है। ये वाले आज के भी मैं शेयर कर देती हूँ।
श्योर मैम
हाँ,
ठीक है।
बट आई नीड टू जस्ट फाइंड आउट जो लास्ट सेशन हुआ इमीडिएट लास्ट सेशन वो
कैपिटल
है
गेन
नहीं
का।
शायद से, दैट नीड्स टू बी चेक्ड।
आई
हाँ,
थिंक
कैपिटल
वो
गेन का।
गया नहीं हुआ है मेरे एंड से ही, तो मैं वो भी अपलोड करवा देती हूँ।
हाँ प्लीज, क्योंकि पता नहीं पोर्टल में तो नजर नहीं आ रहा है, सो
राइट।
इसीलिए
ठीक है।
तो देख लीजिए। ठीक है, ओके।
अजीत जी, मैं आपको मॉर्निंग में शेयर कर देती हूँ।
श्योर मैम
ओके, थैंक यू।
थैंक यू। थैंक
यस।